In this week's video, we'll review the latest charts to help us answer the question, what does history say about a reality check for bulls in 2021? In the opening segment of the video, we'll be quickly covering charts, a few of them as of Friday's close. Not much to report here. We covered this chart in early January. You can see we're well above potential support as of Friday's close. Chart of the 10-year yield as of Friday's close. This chart keeps reminding us that all resistance is possible resistance. We're really just making a V in yields. Here's the plunge that starts in early 2020, the COVID plunge. And much like the stock market, the bond market's just a little late. It's making a gigantic V. It is possible that this area could act as potential resistance, but thus far, all potential resistance has really done nothing. We'll see how it plays out. This is the 200-week moving average that comes in around 2%. You can pause your video player here. This is a slide from a March 5th video study that we presented. It said good things could happen looking out 1 year from the date of the signal. And it might be helpful to check in on the maximum drawdowns. What type of volatility did you have to endure between this point and this point to capture these returns in the historical cases? This is the maximum drawdown chart that we covered a couple of weeks ago, and you can see as of the close on Friday, March 19th, nothing particularly alarming here. From a price perspective, the last thing the S&P 500 did was make a higher high just 2 or 3 trading sessions ago. Has not made a significant lower low in calendar year 2021, and we remain above all of these 100% normal and to be expected retracement levels based on history. Similar situation here, a study that we covered back in February based on the VIX. In those cases, the market eventually moved higher, but over the next year came back to this line and this line. As of Friday's close, we remain above both of those lines. Really doesn't do us any good to establish reference points if we don't use them in the real world. These are reference points that we covered based on breadth studies in January of this year. Once again, nothing out of the historical norm at this point. This is intraday with about 5 minutes left in the session on Friday, March 19th. You may remember the studies that we covered back in January said this was 100% normal and to be expected volatility that investors had to endure between point A and point B looking out 1 year. Historically, what type of returns did they capture if they stayed the course during 100% normal and to be expected drawdowns? This is the table that we covered in the January 15th video. The answer is average return about 12.5%. The median return about 13.2, and maybe more importantly for us, remember these very, very attractive 4-year returns based on those signals. Average return 57%, median return just a hair under 59%. The drawdowns tell us to keep realistic expectations about how markets operate in the real world, and the right side of the table helps us keep a longer-term focus as long as the data that we have in front of us today allows. And just as a reminder, these breadth studies that we covered in January and the studies that we'll cover this week are relevant because they help us with the concept inside of this purple box here. You can pause your video player. And the concepts in the upper right-hand corner of the screen and the concepts inside of this blue box are also relevant to everything that we will cover this week. After the close on Friday, March 19th, how did the chart in front of us look? This is a good proxy or summary of the weight of the evidence. JNK relative to IEF. This was the potential resistance that we've been watching. On Friday, the stock market didn't have a particularly strong close relative to the S&P 500, but the credit markets did just fine. Printed a new all-time high for the rally off of the March 23rd low. And I think you can make the argument that this higher highs here, making a new high when the stock market down here has not made a new high yet, The right side of the screen of the present day is almost the polar opposite of the look here that featured a lower high before the stock market peaked where my cursor is. None of this predicts anything, but this tells you the credit markets were more concerned than the stock market in early February 2020. I think it's pretty fair to say, in terms of default probabilities, which speaks to concerns about an economic recession, the credit markets at this point are probably a little less concerned than the stock market. Like anything else, those statements are based on the facts in front of us. If the facts change, we have to reassess the probabilities. You can pause your video player here and conduct a search, either to find this article here on CNBC or this tweet here, where my cursor is, on Twitter. The general topic is about how artificial intelligence is most likely going to change a lot of things in the next 10 to 20 years. And it provides an example of human nature relative to the financial markets. The text in the lower right-hand corner of your screen, highlighted in green, says it's possible that the value of stocks and the value of privately held land in the United States could possibly double in the next 10 years. That, of course, speaks to the long term. We'll link back to this topic, but first, let's look at a signal that just occurred in the S&P 500 index, an incredibly rare signal that will help us understand a little bit more about probabilities looking out long term, as well as over the next 12 months. This is the S&P 500 as of the close on March 17th, 2021. Only 3 times in the last 71 years have we seen a move similar to what we've seen in the rearview mirror, going back 249 trading days that would take us to the low in March of 2020. The first instance, the rate of change off the low in 1982. You can see the rate of change hits the blue line in calendar year 1983. Similar situation here off of the major low in 2009. We hit the upper blue line early in 2010. Thus, you can make a rational argument that human beings in the present day, from a psychology perspective and from an economic perspective, feel similar in the present day to this period here in early 2010 and this period here in 1983. Why is that the case? In all 3 cases, the market had a horrible drawdown prior to an incredibly strong and what appears to be a surprising rally when we look at it in real time. Psychologically, we feel the market can't keep going up in the present day. It's probably the exact same way here in 2010 for many market participants, and the exact same way after a massive move off of the low in August of 1982. So let's examine the 1983 case and the 2010 case and see what we can learn. Should be noted, this is an apex study. It's based on the apex of the rate of change looking backwards 249 trading days. We don't know if we've hit the apex in the present day. That is to be determined. The apex for the rate of change in this case occurred on July 26, 1983, which would be very, very similar to the present day in 2021. And at this point, July 26, 1983, looking backwards, the market had a massive move. The low was made in August of 1982, and now we're in July of 1983. In the 1983 case, right off the bat, over the next 13 calendar days, the S&P 500 gave back 6.56%. But then it continued to rally and made a higher high, 1.34%, above the high at point A, which is similar to the present day. In this case, it's July 26, 1983. The move from point A to point B took 76 calendar days, and once again, the market closed 1.34% higher than it did at point A on July 26, 1983. That's the good news. I said it's pretty logical to feel in the present day that the market can't keep going up like this. 2010, the market can't keep going up like this. And in 1983, the market can't keep going up like this. Well, ultimately, in the 1983 case, that turned out to be true. Point A is similar to the present day. From point B to point C, the S&P 500 gave back 14.38% of that massive move that comes off of the August 1982 low, which is not shown on your screen. It takes 76 calendar days to make it to point B, and then another 288 calendar days to make it to point C. That would be the bad news. The good news is if you know your market history, from this low here at point C, it turned out to be a fantastic long-term entry point, and it should also be noted. See this low here? It doesn't retrace all of the gains from January 1st, 1983, but it does retrace a significant amount of this move here. And remember, in the present day, we don't know if we've hit the 249-day apex yet. In fact, after Thursday's decline, the 249 trading day rate of change continued to climb. So hypothetically, we have to wait for this to peak. Has to be a sustainable peak as it was here to learn anything about probabilities. But given the magnitude of the move in the present day and relative to what happened here and relative to what happened here, it wouldn't be shocking to see this rate of change peak soon. Hasn't peaked yet. We just covered the 1983 case, which is similar to March of 2021. How about the 2009 case? This gives you a little bit better visualization as to how psychology at this point in here is similar to the present day. The S&P 500 in the rear view mirror has a massive move off of the March 2009 low, and we get that very rare 249 trading day rate of change look here. It's only happened 3 times dating back to 1950. This is case number 2 of 3. Case 3 of 3 is the present day. In this case, we just had a significant pullback, and in this case, the market continued to rally after the apex in the rate of change. It gained an additional 8.4%, and notice that occurred over several weeks, telling us to keep an open mind about better than expected outcomes in the short run, even if we logically get a big give back somewhere down the road. So point A would be similar to March 17th, 2021, hypothetically, or similar to the point where the rate of change rolls over. And common sense tells us after a massive move like this, a pretty big give back would not be shocking. And from this peak here, so hypothetically from the present day, we would rally 8.4%, and then from this point B fall roughly 16%. And it's very, very easy to get preoccupied with this concept here and this number here. This would be the relatively short-term outlook for our approach, which is based on longer-term investment timeframes. Therefore, it might be helpful to know from point A in the 2009 case and from point A in the 1983 case, both similar to March 17, 2021, hypothetically, how did the S&P 500 perform on a longer-term investment time frame, looking out 1 year to 10 years? And we know each one of these cases included a significant and logical give back after this date, but from a longer-term perspective, really good things happened. In both cases, the market was higher 2 years later, 3 years later, 4 years later, and all the way out to 10 years later. And remember, we opened the video talking about how it's normal for us as human beings to be skeptical about the stock market roughly doubling over the next decade. Clients and regular viewers know that we've shown numerous studies based on things that have happened in the rearview mirror that tell us it's quite possible that the stock market could double in less than a decade. Walking forward from July 26, 1983 and March 4th of 2010, the stock market doubled not in 10 years, but in 7 years. Average gain, 110%. Worst case scenario, a gain of 108%. Yes, this is a really small sample size. We don't control the sample size. A decline like this and a decline like this is very, very rare. And a massive rally off the low like this and a massive rally off the low like this, or a massive rally off the low like this, is extremely rare. Once again, we don't control the sample size. Only 3 times over the past 71 years. And in the 2 previous cases, at some point, you got a significant give back. In this case, there was a significant gain and then a significant give back. But for us, it's prudent to keep our eye on what's really, really important. How are we going to give ourselves a high probability of capturing gains on the right side of this table if the present day case unfolds similar to the 1983 case and the 2010 case? And remember, looking out 7, 8, 9, and 10 years, we don't even know the names of some of the companies that would drive a bull market higher. We can get a tremendous amount of innovation over a 7 to 10 year period. Once again, clients and regular viewers, starting out at the beginning of the year in 1983, you get a very, very sharp rally and then a significant give back where almost all of the gains between January 1st, 1983 and early October 1983 are for the most part given back. And that should sound familiar because we've been covering that general concept in these videos since December 11th. This is another example of the Nordique phase of the bull market, where logically after a massive move, having a double-digit give back or an 8 or 9% give back really shouldn't shock anybody. The original case came from 2009, 2010 in the December 11th video. We had a really sharp rally between the date of the signal here and September 18th, 13.95%, and then we gave it all back. Very, very similar to if you bought in here in 1983. And much like this period here, it would be very, very easy to lose your focus at point C, and it would have been very, very easy to lose your focus here in calendar year 2010. But in both cases, good things continued to happen for a long period of time, which simply speaks to the probability of good things happening relative to the probability of bad things happening, which is significantly different from a forecast. Quickly, something else that recently happened. This is a weekly chart that shows the percent of NYSE issues making a new 52-week high. This is a very, very rare move here from the lows in March of 2020. This is a measure of market breadth. This is a very rare and rapid breadth thrust. Over the past 40 years, it's very, very rare to get to this upper blue line. It's even more rare to start from the lower blue line, significantly oversold, and then to shoot all the way up here. How many times has it happened in the last 40 years? Why 40 years? Because we're using all of the data that we have. We have data going back to 1980. How many times has it occurred? The answer is 6 previous times. 1981, the last occurrence was 2011. How did the stock market perform walking forward from these dates, which are similar to March 12th of 2021? As you might imagine, an extremely rare breadth thrust off a low led to very favorable longer-term returns. Average gain 1 year from the date of the signal, almost 19%. 2 years later, 32%. Take a little bit of a break in terms of the magnitude of the gains. The average gain looking out 3 years, 36%. Worst case scenario, 3 years later, a gain of 23%. Best case scenario, the 1990 case, an additional gain of 61%. Tables that show nothing but green somewhat skew reality in the financial markets. Common sense tells us there had to be some pain between this point here, which is our signal date on the right side, and these points here. Well, looking out 1 year to capture the average gain of 19% or the median gain of 21%, The average maximum 1-year drawdown was about 4.9%, the median about 4.2%. Using the date of the signal in the present day, which was March 12th, if we experienced a similar drawdown relative to the historical drawdowns, it could come down to any one of these horizontal lines, including this purple line here, which takes you all the way back to roughly 3,500. Keep in mind, though, that happened 112 days after the signal. So that would be similar to walking forward 112 days from March 12th, and that would be more of a Nordique phase where the market went up and then it went down. The shortest drawdown is right here, this orange line. It occurred 45 days after the signal, and that would hypothetically take you back to 3,800. The moral of the story here is similar to what we've been talking about in recent weeks and months. Most of these drawdowns would keep us above the intraday low that was made on the first trading day in January. And most of these drawdowns would keep us above the Vaccine Monday high and above the September high. None of this is meant to predict anything. It simply gives us logical reference points to manage against from a probability perspective. Relative to this study, if the market comes back to all of these levels, including 3,700, it wouldn't be out of character relative to the historical precedent. Said another way, to get to the right side of the table here in the historical cases, you had to be patient during this type of give back, including one going all the way back here later on down the road. This chart shows the drawdowns as of Thursday's close, and as you can see, there's really nothing here that would be particularly alarming relative to this study. You can pause your video player here and look at this in more detail. If you know your market history, you know the S&P 500, which is shown here where my cursor is, peaked in March of 2000. This shows us NASDAQ new highs minus new lows right after the major peak. Similar situation here. Financial crisis. If you know your market history, you know that we peaked in early October. That's the S&P 500. And this shows us what happened to the breadth indicator weeks after the major peak. In both cases, NASDAQ new highs minus new lows very early on after the major peak went into the negative 300, in this case down to the negative 500 window, and in this case it went into the negative 300 window down past the negative 900 window here. Once again, there's nothing magical about any of this. What it basically tells us is our concerns would increase in the present day if market breadth slipped into a similar window. And on the present day chart, that would be in this window here. So after the massive decline in the S&P 500 on Thursday, March 18th, where are we relative to what we saw just a few weeks after the peak in the financial crisis and just a few weeks after the peak when the dot-com bubble burst in the spring of 2000? If you're a bear, you want to be in this box or below this box. If you're a bull, you want to be above the box. As of March 18th, really nothing alarming here. Here's the box. If we draw the box over here, for the most part, we're hovering around zero. So relative to this case here, we're up here, and relative to this case here, we're up here. Like everything else, we'll learn something either way. If this indicator on Friday or early next week gets into this level here, that would tell us something about increasing bearish probabilities. Right now, on Thursday, this is not particularly alarming. We'll see how it unfolds. Keeping in mind the CCM market model uses a weight of the evidence approach. If you were looking at this chart as of the close on March 17th, is there anything that would jump off the page? Now, we believe the answer is yes. Number one, as we already know, this type of oversold reading that we had in 2020, very rare. We saw it here in 2011, European debt crisis, down here, end of the financial crisis, and here, near the major low after the dot-com bust. The major low comes in October of 2002. Here's your retest in the spring of 2003. This is the S&P 500 where my cursor is. And we know anything that says you look like the low in 2011 or near the low in 2009 or near October of 2002, that's a good comparison looking out several years from the date of those signals. The other thing that jumps off the page, from this rare oversold condition, see how the indicator comes up and kind of consolidates? Here, 2009, come up, similar kind of look. 2011, not as clean, but we're still getting some indecisiveness and kind of a seismograph look, and a seismograph look near the upper blue line. And in each case, before that, you're in the rare oversold condition. I have the same thing in the present day. Rare oversold condition and the seismograph look right here. This look is similar to this look and this look. So we just tied the present day case to this point here in 2003, this point here in 2009, and this general area here in 2013. From a long-term perspective, and notice long-term is underlined. Those are wonderful cases to say the present day, 2021, March 2021, shares something with this blue box, and this blue box, because the S&P 500 did very well from the blue box, and continued to do well from the blue box. Simply telling us something about probabilities, which is significantly different from certainties in 2021. If you look more closely at the S&P 500 here, there's a lot of volatility between point A and point B. We all know it would be wonderful if the stock market went up every day, and we also all know that's ridiculous. That can't happen. It's not possible for our account balances to hit a new all-time high every day. If that were possible, and that's the way it worked, it would be incredibly easy. So pretty fair to make the argument that the green boxes and the blue boxes look similar. Also noteworthy, here's where the S&P 500's peaking right here, October of 2007, before the huge plunge. Look where the indicator is here. Does this look anything like the present day? It does not. So compare this point to this point. Look a lot stronger in the present day over here relative to here. Here's another very unsettling period here. After a long rally, we get somewhat of a double plunge in 2015, then we make a lower low into early February of 2016. Here's the peak. How does the indicator look before the market peaks or in the early stages of this double plunge look in the S&P 500? Once again, it doesn't look anything like the present day. This is before really bad things start to happen. Look at all this white space here. We don't have any white space in the present day. Is it possible that this quickly morphs into something like this and this? We all know the answer. It's very, very possible. It may happen, and it may happen very, very soon. But we know the key is it hasn't happened yet. Conceptually, is there anything that we would look for that would tell us the probabilities are increasing that this type of S&P 500 look could be morphing into something like this? The answer is yes. But remember, we're using a weight of the evidence approach. So we'll use one example as a proxy for the weight of the evidence. You can see the present day using this indicator, NYSE percent above the 150-day simple moving average. This period here and this period here looks similar to the present day on the right side of the screen. If you know your market history, right here in 2004 where my cursor is, right in here, this is not a fun period. It's volatile, and it's just not a lot of fun in here to be a trend trader. Look at the indicator. Here's where it starts. So here's where we are here. Similar situation here. You get the massive rally off the low. Is there something before the flash crash that could have helped us in any way? So let's examine those two areas in a little bit more detail. And like anything else, you can pause your video player here and look at this in a little bit more detail. This is the S&P 500 here. This is the massive rally off the 2003 low, and this is where the period of frustration would begin if you were a trend follower. So if we look at the indicator here, we get 10 months where it stays between 75 and 90. That's this area in here. And notice what's happening in the market. It's still rising. This is the area here where we're looking to see, can we find anything in here that would help us? So here's the S&P. This over here looks quite a bit different than this over here. And you can see the indicator, which helps us monitor the net aggregate opinion of all market participants regarding all subjects on all time frames. The indicator has a change in character. Look at the indicator in this 10-month period and compare it to the orange box. Everybody wants predictions. You don't necessarily need predictions if you just pay attention to what is happening, the facts in front of you. And if you look for subtle changes, it can help. Look where the S&P 500 is here. It's not materially different from this point here. But look where the indicator is. Look where it's been. This is materially different from all of this. It's nothing earth-shattering. It's subtle. If you look inside of this rectangle here, the indicator looks a lot different than it did up here. So in the present day, how do we look? This is the same indicator as of the close on March 17th. We said here when the market was still rising, it stayed between 75 and 90. The close on the 17th was 84. And after the big drop on the 18th, closed at 82 if you round up. Here's where my cursor is. That's 82 roughly, right in this general area here. Hard to make an argument that this area here doesn't look more like this range here where the S&P was still climbing relative to this look here inside of the orange box. This is 2004 on the right side of your screen. This is March of 2021 in this box, and this box is March 18th, just showing you the change from the 17th to the 18th. We just looked at the give back period in 2004 after the strong rally off of the low in 2003. Same exercise here, very similar human behavior. This time it's the 2009 low here. This is the S&P 500. Eventually we go into give back A and then flash crash B here where my cursor is. You can pause your video player, but it's basically the identical analysis to what we just went through. This is the stable period here. It's a 9-month period, 68 to 93. And really from this point is where the change in character starts. Lower high, lower high, lower high. 3 lower highs in the indicator before the flash crash. Range here, 68 to 93. Change of character, 52 to 88. Thus, if you're a stock market bull in the present day, you would prefer this indicator to be in the 68 to 93 range. If you're a bear, you would prefer to see it down here closer to 52. Where are we? Well, we already covered that. As of Thursday's close, we closed at 82. Where's 82 on this screen? It's right in here. Still within the 68 to 93 range, but it's probably fair to say in this case, we may have entered yellow flag territory. Remember, you're in yellow flag territory here, but the stock market rallies for months. This is 2009 here where my cursor is. The final high doesn't come until here. Subtle shifts that speak to a shift in investor psychology. Thus, linking back to our original question, it's quite possible that the S&P 500 from an intermediate term peak sometime in this calendar year could experience a double-digit give back. It's also possible, based on the strength of the momentum in the present day, that it could take some time for that to dissipate, meaning we could be days, weeks, or months away from that intermediate high. As we've been saying in these videos for several weeks now, the path over the next 12 months, even if really good things happen for a long period of time, is highly variable. In almost every historical case that we've covered over the past few weeks, if investors had a respect for normal volatility, they were rewarded on a 2 to 5 to 7 to 10-year period in many cases. The highly variable nature of the market's path over the next 12 months says trade the chart in front of you. From a risk management perspective, walking forward, it's best to make no assumptions, no predictions, and to take it day by day. Maximum flexibility and a flexible, unbiased, and open mind. All of that speaks to keeping your ego on the sidelines. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.